Good morning, good afternoon, good evening. Thank you for taking the time to watch this, wherever you are, whenever you are. This is the April 2026 market update for the Zenith portfolios, and today's date is the 30th of April, which is great because it means we have the entire month to look back on and assess. Now, the last couple of months have been volatile to say the least, and the vast majority of this volatility has been caused by the conflict between the US and Iran. The reason that this conflict has been so impactful is it has had a significant effect on the price of oil. This is because a huge amount of the world's oil comes through a very narrow stretch of water called the Strait of Hormuz that has on numerous occasions either been blockaded by the US or Iran directly. They've done this by either placing ships in the way or simply attacking anything that tries to travel through the strait itself. Now, we have a global economy that is fairly dependent on oil, whether it's getting things from A to B from a logistical perspective, or simply constructing and creating the materials required to build things. Almost every aspect of a supply chain involves oil in some form or another. So the price of oil itself has a huge effect on how profitable a business can be and how much the consumer has to pay for the goods and services they want. And this has also created some uncertainty and concern around inflation, because the price of oil has a direct impact on all manner of things. It can also directly impact inflation. And we've had a number of years where inflation has been a worry and one of the main reasons why interest rates are currently quite high. With inflation potentially rearing its head again, central banks are starting to become apprehensive about lowering interest rates at the pace they previously promised. This means borrowing is going to continue to be more expensive than it was a few years ago, and therefore less accessible for most people. Long story short, this has created a number of different knock-on effects that have meant markets pulled back during March. The Zenith portfolios behaved exactly as we would expect, even if the result was them falling in value. For instance, the Zenith 5 out of 5 global capital portfolio fell 7.07% in the month of March. The most cautious portfolio, the Zenith 1 out of 5 cautious portfolio, fell the least at 3.53%. Depending on where you are in the risk spectrum, your portfolio would have behaved proportionately to the risk that you were taking, falling between these bands in terms of performance in total. Now, April, the story has been very different, and in almost all cases there has been a full recovery. This is evidenced by the graph you're seeing in front of you. You can see that the conflict started with markets bottoming out at the end of the month of March and starting to recover at the start of April. They have now subsequently almost all fully recovered and are back to where they were, and this is a really good sign of market strength and the quality of the underlying portfolios. When we zoom out even further and look at the last 3 years worth of performance, we have a very compelling story no matter what risk profile is appropriate for you. For instance, the Zenith Global Capital portfolio, the 5 out of 5 most adventurous portfolio, has returned 55.32% despite Trump's tariffs this time last year and despite the conflict in the US and Iran that's happened over the last month. The most cautious portfolio, Zenith Cautious, has returned 21.1% over that 3-year period, also despite those things. All the other portfolios have delivered returns between these two brackets and exactly as you would expect. Now, fundamentally, we haven't got a conclusion to the US-Iran conflict as of yet, but for the most part, markets are looking to the near future, i.e. 12 to 18 months, and pricing in everything that they think will happen between now and then. This could very well be why we've seen almost a full recovery at this stage. The last 2 months have been a great illustration as to why investing should be seen as a long-term endeavour and not a short-term interest. As such, remaining invested and going along with the ups and downs involved in the markets remains to be the most important way to deliver good long-term returns. Like Warren Buffett said, it's about time in the market, not timing the market. So looking at things from a 10 to 15 year perspective instead of a 1 to 2 month perspective is absolutely crucial in terms of delivering good returns over a long period of time. If you have any queries about the portfolios themselves or anything you'd like to contact your advisor about, we are of course always available to chat. Thank you very much for taking the time to watch this video. I hope you found it helpful and reassuring, and I look forward to seeing you in a future one. Bye for now.